This is In the Final Analysis. I'm Jim Yockey.
Welcome to the In the Final Analysis podcast. Here is your host and the managing director of Wisdom Financial, Jim Yockey, and I'm the media support manager, Kylie. Welcome to our episode on some of the biases that might be tripping you up lately. So we've been talking a lot on in the Final Analysis podcast recently about the different causes and correlations of uncertainty when it comes to personal finance, often stemming from like the base motivation of wanting to grow your money without losing any money. And those feelings of anxiety and fear can sometimes actually cause people to miss out on useful opportunities sometimes. Jim, could you please explain the concept of loss aversion bias that can cause that?
Yeah, there's been long studies on this, but the truth of the matter is that loss aversion has everything to do with mankind. It's probably part of our DNA. It's fear of being attacked or not, or at a disadvantage or not. And there were a couple of college professors, Kahneman and Tversky, that created a paper or study called prospect theory back in the 90s. And what they found about this indigenous thing that we're calling a bias, and by the way, there are a billion things hitting the waves these days talking about our biases, and you can think of anything and it'll be a bias. But these are our shortcuts, thumbnail shortcuts of what we calculate our decisions with. We have a methodology of doing the same thing over and over to make certain decisions, and they are indigenous to us. They're common. They are we use them, and we really don't understand all of the things that we think about to make a decision because it's automatic. Well, in prospect theory, these two professors found that if a decision question is submitted to you, you're going to take that and make a decision whether it's good for you or not. And then later they can ask you a question that has the same outcome in a different way, and you will say, oh, that's really good for me, or that's really bad for me, which is the outcome of the first question and the outcome of the second question are exactly the same. And therefore, you have made a different decision the second time from the first time because it was presented to you differently. So it's a very interesting decision outcome that we miss getting because we get enraptured by how it's being presented to us. I think the solution to that is to remember that you learn how to make your decisions using small things, and it grows, and oftentimes you'll make exactly the same mechanical ability or psychological ability to make a decision using the same sequence or methodology that you have always used, even for small decisions. This is something that can often lead you to making a wrong decision because the way it's being presented to you will make one decision, and then later on you find out, well, I wish I'd have made a different decision about that. So you can make mistakes because inherently you're trying to make a decision based upon the content surrounding the topic of your decision. So one of the things you can do there, by the way, is just to stop, take a deep breath, and say, okay, what am I trying to out? What's the outcome that I want? And is that going to be better for me or not? And so that'll give you a chance to mentally go back and review the topic and the presentation of the decision before you move forward and actually make a decision about whatever that topic is that is entertaining you at the minute.
Yeah, makes sense. And especially in current times, as we talked about in our last episode with headline uncertainty, how that can be so overwhelming for so many people, and needing to take that minute and think, how then is the concept of recency bias tripping people up when it comes to their financial decision making?
Indeed. That's actually quite related to loss aversion too, because we're looking at particular what the concept of a particular decision that we have to make. And oftentimes we've learned to make instant decisions based upon things that we have most recently encountered. So for example, let's say that you wanted to buy a car, for example, and you have a kind of a decision about what you want, and you start looking around for what you want, and all of a sudden turns around, you see that same car, almost the same color all the time, everywhere. That's that recency stuff. So when you go in to purchase the car, you already have an idea that you have confirmed because of all of the ones that you have seen before. The converse can be true as well. You see so many of them that you say, well, I don't want that one because everybody owns it. So that recency of encountering whatever topic you're talking about, whether it's stocks, mutual funds, whatever you're thinking about, insurance, you're thinking about making a decision on, or even going to the grocery store, for example. Sometimes, you have learned through recent advertising, that one product's better than another product. So you make a decision based upon what you have recently learned and understand about buying something or making a decision about something. And this happens with people too. The first time that you meet them, for example, you may make a decision that you don't like them very well. But then when you get to know them a little bit, you say, I made a mistake. That person is really a good person, because you are again using the more recent information that you've acquired to make the decision about friendship, for example. Does that kind of give you the baseline here?
Yeah, absolutely. So, in relation to these other biases that we've talked about and how they affect your financial decision making, how might the sunk cost fallacy bias exacerbate unhelpful financial decision making and feed into those other biases then?
Sunk cost. That's really a fallacy. True. It's but it's also related to recency and loss aversion too, because we all hate regret about decisions that we have made that haven't worked out the way we wanted. When you have possession of something, you have bought something or you own something. The thing is, you have an investment, especially when you're talking about money, and you have purchased something and you have it and it's worked well for you for quite a while, and then all of a sudden it doesn't respond in the same way, just for the sake of financial behavior. If you buy a stock and you own it for a very long time and it seems to perform for you, and all of a sudden it doesn't, it starts falling and you don't know what to do. So you're looking at that thinking, or if you, even a better one is your 401k, for example, at work, all that retirement money that you're putting away, and you put it away. Maybe you made a good decision or no decision, or so you got information from a coworker or something, and you made a decision how to invest that money in the 401k. And all of a sudden, events change and you start losing money. Well, you have to just stop and think about that, and when you approach it from a sunk cost point of view, the money that you have spent on it already, it makes you linger to want to sell it. even though it may be the right thing for you on a longer term basis, you decide maybe I'm going to hold on to it because it has performed. It's probably going to come back. I think I've liked it all this time. I'm going to continue to like it. And that may be the wrong decision to make. And what you do in those kinds of situations is understand what your mission was when you made that purchase, whether it was an automobile or a stock or any kind of decision where you have money that you have engaged something with. Um, a really interesting parallel to this is kind of off the wall, but this is the truth. If you've ever gone to a casino, which I don't recommend, by the way. Anyway, and you sit down at the table and they start playing cards with them and blah, blah, blah. And you start losing money. And you get down to the point where you're over your budget. What do? You've lost all that money. You know, what? Well, I know that if I stay here a little bit longer, so you come out of pocket with some more money and you start trying to build back what you have already lost, which is probably not a good decision because a casino, they're notorious for wanting you to sit there forever because the longer you sit there, the more money you're probably going to lose. So some investments are different than that. The things that we have uh, as a matter of course, as we make it some kind of an investment. What our mission is to hold it a little bit longer to make it work for us, which is quite unlike what they do at the casinos. So
Yes.
that is a demonstration also of sunk costs. You know, oftentimes you can't make up what is already done. So you need to make a decision of what to do for yourself going forward. And that means you have to have a rational analysis. Write it down on a piece of paper. This is what I did. This is what I'm down. Is it worth it for me to stay with it? And make a conscious choice based upon the current facts and the current data that you can get. And remember too, we all make some mistakes. And buyer's remorse is typical for humanity. I think you buy something, it doesn't work out, and it's really hard to believe that you made that mistake. But you don't want to stay too long either, and that's what sunk cost fallacy is all about.
Absolutely. Thank you so much for explaining all of those and how they can affect decisions with personal finance. Listeners, if you want to test your own biases, such as these and even more, you can check out our bias pulse checks by Alice Point in the Your Money Emotions resources of our financial intelligence tab on our website at www.wisdomchoice.net. We have those as well as risk tolerance quizzes and more there. And we even also have more information on some of these biases in previous podcast episodes, which you can find in our special news tab of the website. And our primary goal here is always to educate. That's why we provide so many resources on our website of so many different topics and special circumstances that you might encounter along your financial and life journey. But if you ever want help with weathering the current times and need help dealing with your own biases when it comes to your financial life, please always feel free to reach out to us via our website or give us a call at the office. All of our contact information can be found again at www.wisdomchoice.net. And you can also let us know if there's any of those topics or any specific bias that you would like to know more information about in a podcast episode or newsletter content or even our white paper updates. You can always reach out to us via email or contact form on our website.
The final analysis.
There it is.
There it is. Remember that we use these heuristics or rules of thumb to make decisions to help move forward in life. Just make sure that you pause and check real close that you're making the right decision based on the data and the presentation. and you'll be much safer going forward.
That's right. Thank you so much for your time today, Jim. And thank you all for listening. And we'll see you in the next episode of In the Final Analysis next time. Bye.
Thanks for tuning in to The Final Analysis. We try to keep you informed. Be sure that you're on the email list and call us if you have any questions whatsoever. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professionals before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Wisdom Financial Management, LLC are not affiliated.